Hello, ladies and gentlemen, for whatever part of the world that you are watching and seeing us right now. For people in Europe, I believe it's good night. For people in Brazil and the United States or Latin America, good afternoon. Today we will have another webinar of the Structuralist Development Macroeconomics Research Group. The person that will deliver the webinar is Esra Nur Ugurlu, which is a PhD candidate in the economics of the Massachusetts Amherst University and research assistant at the Political Economy Research Institute. She holds a master's degree in international economics from Berlin School of Economics and Law, a master's degree in economic analysis and policy from Université Sorbonne Paris Nord, and a bachelor's degree in economics from the Middle East Technical University. Her main research interests are development economics, macroeconomics, international economics, and political economy. So, Esra, can you... Many thanks for have accepted the invitation of our research group to deliver a webinar on your research project, and the word is yours.
Yeah, thank you so much. It's really a pleasure for me to be here. So today I will present a paper which presents a theoretical model inspired by the rapid growth in consumer lending that took place in Turkey, which is my home country. Unfortunately, in the Turkish academia, we don't have a structuralist macroeconomics tradition, or not a strong one, like the one that exists in Brazil or other Latin American countries. Therefore, I have always been a little bit envious of my Latin American colleagues for having these great networks like this research group or ACLAC. Therefore, I'm really glad about the opportunity to present my work here today. And before I start, I would like to thank Marwil Fernandez for his help setting up this webinar and for being my discussant. I would also like to thank Professor Oreiro for chairing the meeting. So there were some technical issues. I could not share the screen from my own computer, so I will be at times speaking to Daniel, asking him to change the slides on my behalf. So it will be great if we can move to the next slide. Thank you. So my presentation today has two main parts. In the first part, I will talk about the growth of consumer lending in Turkey between 2002 and 2018. This will be followed by a presentation of a two-sector growth model, which analyzes the structural change ramifications of consumer credit expansion. Marwil told me that I have about 40-45 minutes, but I believe I will only take about 25 to 30 minutes. So the next slide, please. So let me start with my motivation. Since the early 2000s, developing countries have experienced an unprecedented expansion in consumer lending, which was in large part policy-driven. For instance, in Turkey, stimulating private consumption through consumer lending was a key component of the growth strategy the government has adopted following a major economic crisis in 2001. Regarding the existing literature on consumer borrowing, there are several studies in the post-Keynesian literature which incorporate household borrowing into post-Keynesian growth models. In my paper, I take some inspiration from these models. However, for my analysis to be relevant for developing countries, I also needed to depart from them in some important ways. So first of all, the post-Keynesian literature on household debt focuses on the demand-side drivers of consumer lending whereas I wanted to highlight more of the policy-induced aspects. Secondly, this literature, the post-Keynesian literature on household debt, concerns mature economies, by which I mean economies that are close to full employment, where labor supply can be a constraint on economic growth, and where sectoral differences are less significant. In contrast, my focus will be on deal economies with vast sectoral differences and large pools of open or hidden unemployment. This distinction is key for my analysis because the primary growth challenge in mature economies typically concerns the insufficiency of aggregate demand, whereas the growth challenge in dual economies is more akin to a structural transformation problem. Therefore, in this paper, I wanted to explore how consumer credit expansions interact with sectoral dynamics and structural transformation. Let me now briefly present some stylized facts. On the slide, I will ask to push the space screen a couple times, 2 more times, please. Perfect. So following the economic crisis in 2001, Turkey adopted an IMF-supported program called Transition to a Strong Economy, the TSE program. This program was fully embraced by the ruling party, AKP, which has been in power in a single-party government since 2002. An overlooked aspect of this program, which I try to emphasize in my paper, is that this program has sown the seeds of a consumer credit-driven growth model. So the program, the TSE, was built around 2 main promises, which are fiscal discipline and restructuring of the banking sector. Commitment to fiscal discipline meant that when the AKP came into power for the first time in 2002, they were left with limited scope to stimulate domestic demand because the TSE imposed primary fiscal surplus targets. At the same time, the TSE curtailed the space for industrial strategy that could have been used to stimulate investment. So in subsequent years, the government used consumer credits in quite a functional way to fill this vacuum. The strategic importance the governing party assigned to the construction industry amplified the importance of consumer credit, particularly mortgage credit, even further. At the same time, this program enabled and encouraged the banking sector to give more consumer loans through various policy changes that it introduced. So as an example, up until 2001 crisis, commercial banks in Turkey were earning most of their revenue from financing the public deficit by simply purchasing treasury securities with very high returns. And the TSE program was designed based on the understanding that contracting public expenditures and prohibiting commercial banks from purchasing treasury securities would direct bank lending towards private investors and automatically crowd in investment. However, during the 2000s, private companies in Turkey, particularly large corporations, decreased their reliance on the domestic banking sector because they gained easy access to foreign funding thanks to the low interest rates in the international markets and excess global liquidity. So the end of an era of profiting of high returns on government bonds and lack of demand from large corporations forced commercial banks to turn towards consumer lending. In the meantime, thanks to the banking reforms Transition to a Strong Economy program introduced, several large global banks entered the Turkish banking sector with a view to expanding consumer lending. And the government has always supported their efforts by providing the legal background to develop the consumer credit and mortgage markets. So the end result of these developments was a remarkable increase in the consumer credit to GDP ratio. Between 2003 and 7, this is a period known as the tulip era, the economy enjoyed relatively high growth rates and low inflation rates. For instance, between 2002 and 6, GDP growth averaged about 7.2%, and inflation rate was brought down to single digits in 2002 from an average of 77% during the 1990s. However, the tulip era and the following periods were less successful when we judge it by other indicators, such as stagnating investment rates, a highly overvalued currency, sustained and deteriorating current account deficits, and shifts in the sectoral structure that favors low productivity sectors such as construction and services. So the model that I will present now aims to capture these observations, these developments. I will now go through the key features of the model. There are two sectors, a tradable and a non-tradable sector. It is a short to medium run model, but I do discuss some of the longer run aspects as well. I do this more qualitatively in the paper. I assume markup pricing and a fixed markup in the tradable sector. The relative wages between the two sectors are fixed. Workers are facing credit constraints, and the sole target of the central bank is to aim at a constant inflation rate. So the central bank is inflation targeting. And I will, talk about some of these assumptions in more detail as I'm going through the model. There are two main endogenous variables in the model, interest rate and output capital ratio in the tradable sector. And my ultimate aim in the model is to understand what happens to the output capital ratio if there is an increase in banks' ability and willingness to lend to consumers. Next slide, please. Can we move to the next slide, please? Hello? I think, Daniel could not perhaps maybe hear me, but we will wait. Okay, I believe maybe there was a connection problem from Daniel's side, so I guess we will have to wait until he is back. Oh, okay. So I also shared my slides with Marwil. I'm wondering if he could maybe share my slides. Oh, okay, Marwil can't. Okay, so I guess we just have to wait briefly for Daniel to be back. So due to a technical issue, I couldn't share my slides. My laptop did not allow me. So the moderator who was sharing the slides will be back in a second, and we will continue once he is back. Okay, in the meantime, I think we have a question. Perfect. Yes, please go ahead, Professor Oreiro. Okay, so the question is, what was the average growth rate of Turkish economy at this period? So I have only the number in my mind for the period between 2002 and 2006. So it was about 7.2%. So this was really a high growth period. There has been a decline since 2013. So until 2013, with the exception of the global financial crisis, the growth rate is high, and it has been on a slightly downward trend since 2013. In the meantime, if there are any other questions, please go ahead. Okay, there is a question about the manufacturing share. Don't have the raw numbers in my mind, but the manufacturing share has been stagnating. The construction share and the services share has been increasing. So I have some graphs on my slides that depicts the ratio of the tradable sector to non-tradable sector output. And we observe a very clear upward trend in the non-tradable sector share. Great, so our slides are back. Okay, so I think we are back. So I'll just give a quick recap. Basically, I just presented some of the key features of the model, explained that there are two sectors. We have an inflation targeting central bank. And what I will try to explore is what happens to the output capital ratio in the tradable sector if, let's say, there is a policy change that increases banks' ability and willingness to lend to consumers. So if the connection is all good, we can move on to the next slide, please. Thank you so much. So during the presentation of the model, I will skip some of the equations that you see in faded gray color. This is because, these equations are not key for my purposes, but we can come back to anything that I skip in the Q&A session if there are any questions. Let me start with the first equation. This equation gives the production function for the tradable sector. So the tradable sector uses both capital and labor. As you can see, the production is characterized by a Leontief production function. The non-tradable sector uses labor as its only input. This is given by equation 2. The small letter E that you see here denotes the employment rate in the non-tradable sector, whereas 1 minus E denotes hidden unemployment. Workers prefer to be employed in the tradable sector due to the existence of a wage premium, but those who cannot find jobs in the tradable sector move into the non-tradable sector. Next slide, please. Perfect. So I assume that nominal wages in the tradable sector are predetermined. Given that we have markup pricing and a constant markup, tradable sector prices are also predetermined, and profit share in the tradable sector is given as in equation 6. So basically, income distribution in the tradable sector is determined by markup pricing. The non-tradable sector is characterized by income sharing. Therefore, the average income or the average wage, given that there are no capitalists in the sector, is given by total income, PNYN, divided by number of workers not employed in the tradable sector, which is LN. Equation 8 specifies the growth of wages in the tradable sector. WO stands for the objective or the target wage rate. And as you can see from equation 9, the target wage rate in the tradable sector depends positively on the non-tradable sector wages. So this means that the specification for wage inflation in the tradable sector incorporates relative wage norms, meaning that if there's an increase in the non-tradable sector average income, this puts an upward pressure on tradable sector wages. And given that we have a fixed markup, wage pressures in the tradable sector translate into inflationary pressures. Equation 10 depicts the real exchange rate, which is denoted by eta, defined in this model as the relative price of foreign and domestically produced goods expressed in domestic currency. The small letter n that you see in equation 10 shows the nominal exchange rate, which is a function of the domestic interest rate I, and the blanket variable rho, which captures things like exchange rate expectations or risk premium. I would like to remind you that the central bank is inflation targeting. So if there are any inflationary pressures, they react by increasing the domestic interest rate I, which causes the nominal as well as the real exchange rate to appreciate. Next slide, please. I assume a skeletal banking system in this model. Equation 11 shows that debt taken out by workers, dW, and by capitalists, dC, is equal to deposits by foreigners, MF, and deposits by capitalists, MC. I assume that the interest on lending and borrowing are the same. So with this assumption and equation 11, we basically mean that banks don't have any reserves or profits. I should mention that workers take on debt for consumption purposes. So workers' debt or consumer debt refer to the same thing throughout the model. Equation 13 is the key equation of the model, which captures the debt dynamics. It shows that changes in workers' debt or changes in consumer debt is given by the difference between the target level of debt, dt, and the actual level of workers' debt, dw. So the target level of debt reflects banks' willingness and ability to give consumer loans. So any policy change that lifts credit constraints faced by consumers can increase the target level of debt. So as I explained, for instance, at the beginning, policy-induced transformations in the government financing and banking sector in Turkey have led to a diversification of banking activities towards consumer lending. So any increase in the target level of debt reflects this sort of policy-induced expansions in borrowing opportunities faced by consumers. In this model, financial inflows take the form of changes in deposits held by foreigners, which is denoted by M.F, given by equation 14. Equation 14 shows that changes in foreign deposits is given by interest payments on foreign deposits minus net exports, which means that financial inflows are determined endogenously within this model. So throughout the model, when I use hats, it refers to growth rates, and dots refers to time derivatives. Next slide, please. I will now explain the demand structure. Equation 15 depicts aggregate consumption. I assume that workers consume all their earnings, whereas capitalists save a fraction S. The term that I underlined by the red color shows that all non-tradable income is spent on consumption. The navy blue term gives the consumption of workers in the tradable sector. The green term shows consumption out of net borrowing. And the last term captures the consumption of capitalists out of their profit and net interest income. Total consumption is divided into three: consumption of non-tradable goods, consumption of domestically produced tradable goods, and consumption of imported tradable goods. Each of these three goods receive a fixed share of total spending. Next slide, please. I will now explain the investment behavior. So capitalists use both domestically produced and imported tradable goods for investment purposes. Equation 21 gives the investment function with capacity utilization as the only argument. Given that we have a Leontief production function, I can basically use the output capital ratio in the tradable sector as an indicator of capacity utilization. Given that this is a short-run model, I assume that the Keynesian stability condition is satisfied. Equation 22, which is the last equation that I need to set up the model, gives net exports. The first term gives exports, which is a positive function of the real exchange rate, which means that the Marshall-Lerner condition is satisfied. The second term denotes imported goods used for investment, and the last term indicates imported tradable goods used for consumption. So by subtracting these two terms, import of tradable goods used for different purposes from exports, we obtain net exports. We have now basically set up the whole model. So to solve it, we just need to define the equilibrium conditions, which are given by equations 23 and 24. These two conditions simply impose that total income is equal to total spending in the non-tradable and the tradable sector, respectively. So far, the setup of the model was relatively simple, but given the existence of two models, the solution of the model and comparative statistics were slightly algebraically involved. Therefore, I decided to skip all the intermediate steps and just jump into the main result of the model, which is given by equation 25, which shows that an increase in the target level of debt by expanding debt given to workers result in a decline in the tradable sector output capital ratio, or the equilibrium value of the tradable sector output capital ratio. And to understand how an increase in D.W affects the non-tradable sector, we can look at equation 23. In this equation, all the parameters such as P and E, B, and lambda, they are all fixed. So in equilibrium, a decrease in sigma, which is the output capital ratio in the tradable sector, corresponds to an increase in the non-tradable sector output. So in other words, we observe that a policy-induced expansion in consumer lending, so an increase in D.dt by increasing D.W, changes the sectoral composition of output in favor of the non-tradable sector and against the tradable sector. In the next slide, I will try to explain how we reach this conclusion in more verbally. So we basically considered a policy change that increased banks' willingness and ability to lend to consumers. Banks' increased appetite for consumer lending resulted in an expansion of consumer credit because workers were previously credit constrained. So when there are banks who are willing to give them credit, they are basically happy to take that. And the expansion in consumer credit resulted in higher demand for all the goods, including for non-tradable sector goods. And higher demand for non-tradable sector goods translated into higher income and higher average wages in this sector. If you remember, we assumed the fixed relative wage structure between the two sectors, meaning that tradable sector wages also increase if there is an increase in non-tradable sector wages. And given the existence of markup pricing and our assumption of fixed markup, any wage pressures in the tradable sector translate into inflationary pressures. The central bank, who is just concerned about inflation, intervenes whenever there is an inflationary pressure by increasing its policy rate, which causes the nominal and the real exchange rate to appreciate. An appreciation of the real exchange rate results in loss of competitiveness in the tradable sector and a contraction of the tradable sector output because we assume that the Marshall-Lerner condition is satisfied. And given that we can assume a fixed capital stock in the short to medium run, contraction in the tradable sector output translates into a lower output capital ratio in the tradable sector, with a corresponding expansion in the non-tradable sector output. Next slide, please. Now I will try to discuss, what we can really make of these results. In my opinion, it is possible to liken the outcome generated by this model to a case of premature deindustrialization or a financial resource curse, given that expansion of a financial resource, in this case consumer credit, resulted in the growth of a low productivity growth sector at the expense of a high productivity growth sector. While this is a short to medium run model, several factors point that the adverse effects could be amplified in the long run. I discussed some of the long run implications in the paper and would be happy to talk a bit about them in the Q&A session if there are any questions. Regarding the policy implications one can derive from this exercise, the model basically suggests that, or the way I interpret this model is that populist measures aimed at lifting borrowing constraints on consumers may not be compatible with successful industrialization. In other words, boosting domestic demand through consumer credit expansions is not really a developmental strategy, and in fact, it can have adverse implications for the sectoral structure. And although I based my model on the Turkish experience, I strongly believe that the model is relevant for some other developing countries as well, such as Brazil, which experienced, I believe, a similar expansion in consumer lending through the growth of wage-linked loans, which are called crédito consignado loans. And finally, there are unavoidably some caveats to the model and some potential ways to extend it. I discussed some of these issues in detail in the paper. And in future work, I would actually like to build on this model, maybe to answer different sets of questions. So if you have any suggestions, any ideas for potential extensions, or any criticisms regarding the setup of the model or the assumptions, I would be really happy to hear them. And finally, I would like to maybe show some of the graphs that I put under the extras. If I had control over the slides, I was planning to visit some graphs as I was presenting, but I will just show them very quickly at the end. So if we can move to the next slide. So basically, in the slides, we observe the rapid expansion in household lending. So if you look at the top left panel, you can see that household credit to GDP ratio increased really significantly from 2002 up until 2013-14. And in the next slide, we see the high growth rates between 2002 and 2006, but since around 2011, GDP growth has been exhibiting a downward trend. In the next slide, we see that the inflation rate has been constant, so has been brought to single digits in 2004 from an average of, I think, 76 or 77 throughout the 1990s. So the reforms were maybe successful in this respect. It really managed to bring inflation rates down. However, if we look at the next slide, we see that the current account balance has deteriorated quite significantly. I should have maybe put the numbers for the 1990s as well. So occasionally we see deficits, but deficits were not this big and were more occasional. It wasn't sustained. And the next slide, we see the real exchange rate. So if this index is above 100, it means that the real exchange rate is overvalued. And we can see that around 2002 to maybe 2014, the real exchange rate was overvalued. And finally, in the next slide, we see the output and employment ratios between the non-tradable and the tradable sector. So from the first panel, panel A, we observe that construction to manufacturing output has increased rapidly, significantly, and from panel B, we observe a similar trend in the non-tradable to tradable sector employment. So thanks very much for listening to the presentation. Apologies again for some of the technical issues. So I'm really looking forward to hearing your questions, comments, and criticisms. I can't hear you, Professor Oreiro. I think you're muted.
Yeah, sorry. Many thanks, Esra. After Marwil makes his comments, I will do a couple of comments on the structure of your model, and mainly on the structure of the banking sector, right? But for now, let us invite Professor Marwil Dávila Fernández from Bucknell University, who was my student some years ago, and we have co-authored many papers. The last one on the structural change and economic dynamics, about a new developmentalist model of structural change and economic growth and middle income trap. So I think that, Esra, what you present here today has immense overlap with the research program of our group, right? But for now, Marwil, you have the word.
Thank you very much, Leila. Thank you very much, Esra. So, can you guys hear me?
Yes.
Thank you, Esra, for being here. We had the opportunity, I mean, for those that don't know, we met each other at UMass some years ago. We did some courses together with Professor Scott there. It was a lovely period at UMass. So I'm very happy to have you here. I'm extremely happy of reading the paper. It's beautifully reading. The argument has everything to do with what we do in this research group. I mean, this group is about structural change and policy and development policy. And you have these two ingredients in your paper, in your model, in what you're doing. You're connecting a policy regime, you're connecting a combination of political variables, a political arrangement, and structural change. So I think it has everything to do with what we're doing in this group. It's very well written, the paper. It's a paper that I hope will find a space in the pages of a very nice journal, and I will have the chance to quote it in the near future. For the purposes of this webinar, I would like to raise some points and perhaps give you some suggestions that hopefully you will find useful or interesting in this agenda you are pursuing. The first thing is the first 2 points are more clarification observations. So the first one, I think it's kind of easy for you to perhaps explain how the industrialization enters in the model. In the paper, you talk about premature deindustrialization and how this regime has somehow led to premature deindustrialization. You showed some graphs of the non-tradable sector as a proportion of the tradable sector, construction GDP versus manufacturing GDP, and employment in the non-tradable versus the tradable. But I was wondering how it enters in the model, so how deindustrialization could enter the model. That's the first clarification question. And a second clarification question, I was wondering if you could elaborate a little bit more on the model is somehow of a short-term model because you have the Keynesian stability condition, but then you're also talking about structural change, which usually scholars, I think, we kind of think about structural change as more like a long-term process. So how your discussion and your formalization relates to the time dimension of the process you have in mind. So these are 2 clarification questions. And I don't know if I should make my suggestions after or I should make them now. What do you say, Oreiro?
Maybe now.
Okay. So these the previous 2 points were clarifications. Then I was wondering if we could speculate a little bit about your work. And you assume that the markup is constant, but then you have a discussion about the real exchange rate, and I think there is in different demand-led inside the demand-led growth tradition, or among alternative theories of growth and distribution, there are some scholars that have argued that the markup is somehow endogenous to the real exchange rate. So I was wondering if we could speculate a little bit here. You think your results are going to change or could change if the markup was endogenous, or not? Actually, you think making the markup endogenous will actually increase the strength of the effects we're finding? So this is kind of a suggestion, because it's something that you could also explore in future research. And a second suggestion definitely goes beyond the scope of the paper right now, but I think you have room to explore the dynamics. You have a discussion on the equilibrium, but something interesting about structural change is that you have a lot of space for exploring the dynamics, not only adjustment dynamics, but also different kinds of possibility of persistent fluctuations, of cycles of structural change. Or anyway, so this is a suggestion for, if you have this in mind for the next years, perhaps to explore also the dynamics of it. Thank you again, Esra, for being with us. It was a beautiful, beautiful paper. I'm so happy to have you here.
Thanks very much, Marwil. I mean, these are amazing set of questions and suggestions. So should I try to respond to them now, and then we
Yes, please respond it. Then I will make my own questions.
Okay, perfect. So the first question about how the industrialization enter into the model, this is a great question. I think maybe something that I should make even more clear in the paper. So basically, when we look at the comparative statics in the model, we see that expansion in consumer lending increases the non-tradable sector output and decreases the tradable sector output. So basically, a high productivity growth sector, the tradable sector grows, and the non-tradable sector, lower productive sector shrinks. So this is basically what I mean when I am talking within the context of this model, the industrialization, because the industrial sector is not really benefiting from the process of expansion in consumer lending. And regarding your second point about, structural change being discussed as a long-term process, I think this is absolutely right. But I think it also makes sense to look at the issue from different time perspectives. So I started first working on the short-run model, and I must say this was my first ever experience working on a model myself. And I had the idea of extending it into long run, but I decided that I had enough for one paper. So maybe the long run extensions will be an issue for another paper. But I think the short run aspects matter as well, because, we had this discussion actually with Marwil in the past. Policymakers are in general short-term focused, and they see, expanding credit as an easy or a quick way of stimulating domestic demand and perhaps generating some economic growth. But when we look at it, this process could maybe be beneficial in the short term from some perspective, but it may come at the expense of a more sustainable growth experience in the medium to long term. So in this sense, I think it is also important to look at the more shorter run aspects of a process of structural transformation. So in that sense, I actually think that having a short run model is not necessarily a bad thing, because it speaks to what policymakers do and how it might actually not be beneficial in the longer run. Regarding, the constant markup assumption and the idea of endogenizing that, I guess, the short run, having a short run model also helped me in some respects that some of these assumptions are okay in the short run, but I think it would definitely need to be either relaxed or considered to be relaxed more significantly. Honestly, I haven't thought about the idea of making markup a function of the real exchange rate, but I would need to think a bit about how it would change the results. But it is quite important because with the fixed markup, wage pressures, translate into inflationary pressures. So it might make the results even worse or better. So it's important in that sense. I need to more, clearly think about that basically.
Because you kind of show that, at least the empirical, when you revisit some empirical evidence, you have that during that period, that growth regime, you have an overvalued exchange rate.
Yes.
So with an overvalued exchange rate, I would expect markups to fall, right?
Yes, because it is basically making some of the like imported tradable goods that firms import cheaper.
Could
And
this increase the effect of your finding, perhaps? Make it stronger? I don't know. Because then your markups are falling, you should have an impact also on. Anyway, it's a speculation, but it's something that I think some scholars in the demand-led growth tradition have explored. I mean, Oreiro comes to my mind, but also Blacker and others. So it will be something interesting to explore.
Yeah, I think that's a good idea. I mean, I must say I don't even discuss this as a possibility in the paper, but I think it needs to be added there because I discussed some of the longer run discussions more qualitatively. I think I should think about that and bring that up. Yeah, I will, I think, definitely take on that suggestion. It makes sense to me. And regarding, the idea of room to explore the dynamics, I mean, I can only say that I agree with you. I don't know if I can do this in this paper given the amount of material that I already have, but this is definitely a paper that I want to, or model that I want to build on in future work.
Well, Danielle, can you put again the slides of Esra, please? Come back to the financial sector, to the banking sector equations. Coming back.
I think two more.
Two more, back, and back.
And one more time.
One more time, yes. Okay. So, Esra, I will make some questions for you. Okay. First, about equation 11. DW is the debt of workers, I believe.
Yes.
Is equation 11 is a balance sheet of the banking sector?
Exactly.
So what the banking sector has in assets and as obligations? What are the both sides of the balance sheet?
So we have just that and deposits. So we don't have any reserves or any other financial asset. So I assume quite a simple banking sector. So it's like a skeletal model. We only have deposits and credit.
So demand deposits.
I haven't really specified what type of deposits they are.
I suppose that, well, if it is a simple model, you are using the most simple concept of money, which is, well, in general, will be M1, which means the sum of demand deposits and the paper money on the pockets of the public, right? But in your model, there is no there is no high-powered money. I am correct?
Yes, that is correct.
So, if there is no high-powered money, in fact, the banking sector had infinite supply of credit. There is no limit for banks to lend. In this kind of model, the supply of credit is demand determined. So, the first question that I want you to answer to me is, what limits the credit supply of the banks? Why? Because in equation 13, when you explore the dynamics of the workers' debt, you write that the rate of change of workers' debt is a function of some target level for debt of consumers.
Yes, so that is the level of debt banks are willing to, or level of credit banks are willing to provide to consumers. So they have an amount in their mind, okay, we are going to give this amount of money to consumers.
But why there is some limit for bank lending if there is no if there is no monetary base in your model? What limits the banks to simply supply infinite quantities of loans to their clients?
So basically, I mean, I think, the empirical evidence shows that consumer sector in Turkey, I believe this would be the case in many developing countries, were credit constrained. So banks don't find them creditworthy enough and they don't meet all the credit demands. But what I try to capture by this term DT is that there are actually some policy changes that increase banks' willingness and ability to give consumer loans. So let's say in the past, there wasn't a legal background, a legal system for credit card usage or for mortgage credit, but several policy changes took place which made banks to turn toward consumer lending. So DT is basically a policy determined variable in this model that captures the transformation of the banking sector toward consumer lending. So firms, for instance, in the model don't face any credit constraints. They can get whatever they want, but workers are credit constrained. But there has been an expansion in banks' willingness to lend to consumers.
Well, I know that in the real world is exactly what you are saying, but I'm trying to think in terms of the equations presented in your model, right? So, if banks if there is no monetary base, there is no reason at all for banks to make some credit rationing. I think there is no reason in the model itself. But there is another issue that I think that deserves more attention in your model. DT, the target debt of the banking sector for workers, is a level variable, isn't it?
Yes.
Level, all right. But if the economy is growing, the wages are also growing. So this target should be expressed at least in terms of a ratio, a ratio between the total wages and the total debt of the workers. Express the target in terms of level of debt makes no sense, because if the economy is growing, wages, the mass of wages is growing as well. So is it possible, if the wages are growing faster than the workers' debt, that the level of independence of workers can be reduced, or being reduced over time? So I think that you have to normalize your equations, first of all, right? So where's the central bank in the model?
Yeah, I mean, I have not specified the central bank behavior explicitly, but it comes in when I solve the model, I impose a constant wage inflation condition. So the role of the central bank enters into the model more implicitly. So the central bank, what the central bank is doing is to increase the interest rate if there are inflationary pressures, and they do this so that the wage inflation is constant, and that is needed to have a constant inflation condition.
But if you have the central bank in the model, so the balance sheet of the commercial banks has to be modified, right? Because the central bank can make loans to the banking sector, and so you must have another asset on the well, you have to change the balance sheet of the banking sector. And let me well, I'm worrying about the stock and flow consistency of your model. I would like to see flow transaction matrix of the model in order to be sure there is no black holes on the model.
Yeah,
right? I think that is important.
Yeah, I have an appendix in the paper where I actually show the stock flow consistency. So basically, I show that D.W changes in workers' debt plus D.C is equal to M.F plus M.C. And to get there, I basically use all the equations. So equation 13, 14, and equation 12. So by basically using those three equations that you see on the slide and combining that with the IS equation, I show actually that the stock flow consistency is satisfied. But yeah, I will take your comments and we'll revisit to see if there was anything that I missed out. But I believe, I mean, I think the stock flow consistency of the model is fine.
Why not trying to use some Basileia index as a mechanism to generate the credit restriction in your model? Because under the Basileia agreements, 1, 2, 3, or I don't know how many agreements had in the past, but banks are obliged to have a minimum net worth ratio to their assets. So when banks expand credit, they are expanding their assets. And in order to accomplish the Basileia index, they also have to increase their net worth, right? So you can create, my worry about your equation 13 is that it looks like a shortcut. You're doing a shortcut in your model in order to introduce consumer credit restriction for consumers. Is a shortcut, but is an ad hoc assumption, because the structure of your model do not allow it for banks to restrain their credit. They have no reason at all. Because if there is no worry, no concerns about Basileia Index, if there is no high-powered money, why the banks will not supply all the credit that is demanded at the interest rate they fix it? This is a logical argument, you know. I'm trying to argue with the logic of your argument. I know that in real world is it, right? But trying to argue in terms of the logic of your own model. So if there is no high-powered money, and if there is no Basileia Index, why banks will restrain or constrain credit to consumers? Why banks will not supply all the credit that is demanded at the interest rates they fix it? That's a question. I am absolutely sure that a referee will ask this to you when you send it to the journal.
Yeah. So, like, what would be, I mean, if you have any, what would be your suggestion? I mean, I think I understand your point that, you know, maybe the empirical evidence is strong enough to argue that workers are credit constrained and we have an increase in DT. But what would you, for instance, add to the model to make it explicit that in the model banks had a reason to constrain credit to workers, but then they decide to increase it due to a policy change?
I think that you have to introduce net worth on the balance sheet of banks, and then define the some ratio of banks' assets to net worth that they are obliged to reach by some regulatory mechanism like the Basileia Agreement. And second suggestion, I think that you cannot define this target debt level. You have to define in terms of ratio, right? That's my comments about the banking sector, but I have some other comments about the rest of the model. Please, I really like to, I really want to help you to improve the model. I think that model is very interesting. So don't take my comments as a
absolutely
not.
Yeah,
right? So,
no, absolutely not. I mean, this is really helpful because, you know, honestly, I never thought that, you know, it could be a problem if within the context of the model, banks don't have a reason for not giving credit to workers, because in my mind, that's like so obvious because of
yes, but it's obvious because obvious, but it had a reason for that, you know. So the model had to explain it. The conclusion had to be based on the assumptions of your model. If my issue is that the assumptions of your model do not allow you to introduce a credit constraint for consumers. That's my point.
Yeah, right? Yeah, I think I get the point. Yeah, thanks very much for bringing this up.
But can we see a little more, please, Danielle? To the next slide, the investment function. Investment. No, other one.
The next one.
Next one. Yes, the investment function. Well, here I think we have a problem, because this function, this investment function, will not be accepted by no one in the heterodox literature. For instance, Marxists will say that you are not including the rate of profit, but people like Baduri and Marlin would say that you're not including the profit share. Right? You have a very simple investment equation where the growth rate of capital stock depends only on capacity utilization, because the capital output ratio, this in your model, is proxy for capacity utilization. I suggest for you to include, for instance, the profit share. And when you introduce that in an open economy, changes in real exchange rate will have effect on profit share and will affect the investment rate, the growth rate of capital stock. I think that is an important component for discussing open macroeconomics for small economies like Brazil, Turkey, so on and so forth. In your investment function, you have to introduce the profit share, and remember that the profit share is affected by the real exchange rate. When you have devaluation of real exchange rate, profit share increases, and this has a positive effect over the growth rate of capital stock. When you have a valuation of real exchange rate, is exactly the opposite. This will reduce the profit margin, the profit share, and this will have a negative effect over the growth rate of capital stock. So I think that you have to put another element on your investment equation, right?
Yeah, but I mean, I thought about maybe introducing a profit share term, but I don't know if it really does change the result, given that I assume a fixed markup.
Then we have a problem, because changes in real exchange rate will change income distribution. You cannot ignore that.
I mean, given
so I think that you have to. I think that Marwil have suggested that, and this discussion is on the Satterfield 2002 book on demand-led growth theory, the chapter of Robert Blacker. He presents the Neo-Kalexian model for an open economy, and then discuss the effects of real exchange rate variations over income distribution, and so over capacity utilization and economic growth. So since you are working with an open economy, and for sure with real exchange rate variations, changes in real exchange rate will change income distribution between profits and income. And this has to appear in your model. The simple way to do that is to suppose that the markup is a function of real exchange rate. Blacker has the easiest way to do that on his chapter on Satterfield's 2002 book. I think that would be very useful for you to consider that, right?
Yeah, I mean, yeah, I wanted to kind of like have a simple model, short run model, where I thought it's okay to assume a fixed markup given the time frame I'm operating under. But I completely also get the argument about endogenizing the markup. So yeah, I will basically take that absolutely into consideration, whether I want to extend the model in that direction or not. I mean, it can be a very useful direction. Yeah, but basically, just to answer, the reason I decided to leave out the profit share in this model was because I thought it just wouldn't change the results, given that I assume a fixed markup because I'm in the short run. But I will, at the very least, discuss what the implications would be if I were to endogenize it, or maybe I will just try to do it.
All right. So yeah. Let me now try to understand the short-run equilibrium of your model. In the short-run equilibrium, you determine the capital output ratio and the growth rate of capital stock.
Output capital
what are
ratio,
the endogenous variables?
Output capital ratio and the interest rate.
Interest rate is determined by what equation? Can you?
So I haven't really included the solution of the model on the
Right.
slide
Okay.
because it's got a bit more involved algebraically. So I decided to leave that out. I thought I'll just try to focus on the main argument or the dynamics that give me that result.
Okay.
Mm-hmm.
So, Danielle, please just next slide if I have another comment. All right, next slide. Interpretation of the result. Increase in banks' willingness to lend to consumers, expansion, higher demand, real exchange rate appreciation. Okay. Well, I have to read the paper in detail in order to have more comments to you, but I think that these are the comments that I want to do for you. Marwil, do you have more comments or suggestions?
No. From my side, I think again, it was very nice reading the paper. You did a great job, and best of luck.
Yeah, thanks very much for both of your comments. I think it really gave me some new ideas, new things to work with that, some of which I haven't previously thought a lot about. So this is quite helpful for me in that respect. So thanks very much.
And about the Turkish economy, there is much similarities with Turkey and Brazil in the 2000s. We also had a credit boom, a commodity boom, a real exchange rate appreciation, and premature deindustrialization, but we have low and stable inflation from 2004 until 2010. Afterwards, it increased, but I think that there is a lot of common features between the Turkish economy and the Brazilian economy. And I think that your task to understand the dynamics of the Turkish economy using a structuralist approach, assuming a dual economy, I think that is much important. It's very important. I think that one problem with economics as a science is that it is a British-American science. So it is the models presented even by heterodox economists are thought for developed countries. And so they those for instance, the debate between wage-led growth and profit-led growth, there is a debate for European countries that had a stagnant demand, and they are trying to manage this problem. But for us that are not developed countries, the most important thing is structural transformation. I think that Peter Scott had already told this to you a lot of times, and that's our vision about economics. That for developing economies, structural change is fundamental. So we have some interests that are not identical in terms of theory and empirical evidence to those of our colleagues in the developed countries.
Yeah, absolutely. I agree with you on that 100%. Also, of course, as a student of Peter Scott, I mean, I was lucky to complete most of my postgraduate education in departments with very strong post-Keynesian traditions, but that focus on advanced economies and lack of attention given to these issues like structural transformation is actually what made me look more into the structuralist macroeconomics. So I think you are quite lucky in Brazil and in Latin American countries to have more people interested in this school, interested in this stuff. Hopefully we will also do more, pick up more on this side of the world.
All right. Thank you very much, Esra. Thank you very much, Marwil. I think that we have no more questions, but if you want to say anything more, Esra, please.
No, that was all from me as well. Thanks very much for listening to me and for your comments and questions and for your time.
All right. So, many thanks, Esra, for your brilliant presentation. Many thanks, Marwil, for the comments. Many thanks for everyone who listened to us, and see you in the next webinar of the Structuralist Development Macroeconomics Research Group. Take care of yourselves and have a nice weekend.
Thank you. Thanks, everyone.
Bye-bye.
Bye.